In this week's video, we'll cover 3 brand new, hot off the presses studies that continue to tell us the stock market's 5-year outlook is extremely favorable. Everything that we'll be covering in this week's video speaks to something that has already happened and ties in nicely to this quote from Market Wizards. Technical analysis tracks the past, it does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. Which is exactly why the breath thrust in early January proved to be helpful. It told us that the recent activity of some traders told us to be open to other traders coming in behind, buying and pushing the market higher. The same concepts apply to demographics and spending patterns. As we walk forward in time, the baby boomers are becoming less relevant and the millennials are becoming more relevant. And between now and the year 2035, the millennials will be in the demographic sweet spot relative to earnings and consumption. The demographic analysis we covered in detail in October told us that the present day, where my cursor is in the upper right-hand corner of your screen, is similar to this window in here. From this window here, really good things happened in the stock market for a long period of time. In the extremely rare recycled DeMark counts that we covered on Short Takes on November 15th, 2019, and the table that was included in that post aligned very favorably with the demographic data. And the recycled DeMark counts added to the weight of the evidence that told us to be open to a 1995-like move in the stock market. You can pause your video player if you'd like to read these bullet points from a November 16th tweet that told us there were numerous reasons to keep an open mind about 2019 and 2020 having similar characteristics to 1995. And since the market has remained for the most part in an overbought state since mid-November, all of these concepts have proved to be extremely helpful in terms of keeping an open mind about much better than expected outcomes occurring between November 15th and mid-January 2020. Do we have any other facts in hand that align with all of this? The answer is yes, but it's important to note the charts that follow are long-term big picture confirmation signals, after the fact signals for us. There's a ratio of 2 mutual funds. Why are we using mutual funds? Because the data goes back further than ETFs. This is the ratio of the S&P 500 to a diversified basket of bonds. If you're familiar with ETFs, think SPY divided by AGG. Chart shows stocks versus bonds, simple 275-day moving average in blue, and the simple 300-day moving average in red. The look of these moving averages recently returned to what we call a full-bore bullish look, where blue, the fastest moving average, is on top and the slopes of both moving averages are positive. How many times has this happened in the past, and what can we learn? We'll start our study in 1991 because that's where the data starts. We move back to a full-bore bullish look on September 13th, 1991, similar to what just happened on December 30th, 2019. To understand how this can be helpful, let's move this date here down to the lower left-hand corner of your screen. This is where we return to a full-bore bullish look, similar to what happened at the end of December in 2019. If we walk forward from here, good things happen for a long period of time in the stock-bond ratio until it started to roll over in early calendar year 2001. And just as this signal proved to be helpful walking forward, this signal proved to be helpful walking forward, but this time in a bearish manner. Bad things happened for a long period of time in the stock-bond ratio after we returned to a full-bore bearish look. A full-bore bullish look was restored on September 16, 2003. And if we cover the entire period, you can see we don't get new signals very often. The signal in 1991 proved to be helpful. How about the signal in 2003? It was also helpful because good things happen for a long period of time, and this look here was similar to this look here, and like this case here, bad things happened for a long period of time. And then we reverted back to a full-bore bullish look on January 6, 2010, just similar to this point here in 1991, and similar to this point here in 2003. Let's quickly cover the remaining cases, then move to a table. We have a full-bore bearish look in here. Blue, the fastest moving average is on the bottom, and the slopes of both moving averages are down. We return to a full-bore bullish look on September 14, 2012. So let's move this date here to the lower left-hand corner of your screen and walk forward and see what we can learn. This look here is similar to what just happened at the end of December 2019. And once again, good things happen for a long period of time in the stock-bond ratio after a similar signal. And then we had evidence of a waning bullish trend here in calendar year 2015. We reverted back to a full-bore bullish look on October 10th, 2016. And from that point, walking forward, good things happen for a long period of time. This chart shows the signal that just occurred in December of 2019, the signal that occurred in October of 2016, and the signal that occurred in September of 2012. Thus, we've covered every signal dating back to 1991. Thus, it will be helpful to know, since this just happened at the end of December, a few calendar days ago, what happened in the historical cases walking forward, looking out 1 month to 5 years. And before we show what happened in the historical cases over the first 6 months, remember, these are not timing signals, these are confirmation signals for us. What does that mean? That means we bought way back here. We're trying to decide the allocation that we have today, does it make sense? The confirmation signals can tell us yes or no. And thus, these are not timing signals. Walking forward from these dates, the historical performance for the S&P 500 helps us with that all-important realistic expectations concept relative to 100% normal and to be expected volatility that occurs within the context of any trend. After seeing something like this, which tends to be a little bit late, it would not be surprising to see the market have somewhat of a consolidation or give back look over the next 1 to 6 months. However, this type of give back relative to the gains that we have in hand does not really fall into the particularly alarming category. 80% of the cases walking forward were higher 6 months later, with an average gain of roughly 4% and a median gain of roughly 6%. Not bad. But this is the time frame that's more relevant to our investing time horizon. And like many of the studies that we've performed in recent weeks, 9 months later, 100% of the cases higher, 1 year later, higher, 2 years later, higher, 3 years later, every case higher, average gain of roughly 30%. 4 years later, every case higher, average gain 50%. 5 years later, every single time the S&P 500 was higher, with an average gain of roughly 61%. Simply telling us to keep an open mind about better than expected outcomes, walking forward from a long-term perspective, and to have very realistic expectations about how markets operate in the real world. Headline from Friday, January 17th, 2020. Housing starts soar 16.9% in December to a 13-year high. Why is that relevant? Because as we've covered in the past, housing tends to peak before the shaded areas, which are recessions in the United States. These figures here tell us it wouldn't be shocking to see this chart make a new cycle high in the coming months. These figures here, based on something that just happened, seem to align very, very well with everything that we've covered since January of last year. Is there anything else? Yes, and it ties in nicely from the video a few weeks ago that covered the concept of debt has never been higher. These scary charts of debt are always shown, but as we covered in detail in this video, and you can find it by Googling the title on the screen, this chart only tells half of the story. The level of debt viewed in isolation really doesn't tell us anything. What matters is the ability to service the debt, make the payments, and the ability to take on new debt. And we have some brand new, hot off the presses data that aligns very, very nicely with all of this. January 14, 2020, the average American's credit score has never been higher. And that speaks to the ability to service their existing debt and take on new debt. This data here aligns perfectly with everything covered in this video here. And you can easily find articles that takes this news and tries to spin it in a negative manner. When you read something like that, keep in mind, any statistic about debt levels, average debt levels, rising debt levels, debt balances, or average debt balances, all of that tells us very little about the ability to service debt and take on additional debt. We need to examine a much wider data set. And more good news. As millennials are entering their peak spending and earning years, their credit worthiness is improving. This aligns nicely with everything that we've talked about over the past year or so. Anything else? Yes, and we'll walk through this quickly. You can pause your video player if you want to take a harder look at the chart. It's Emerging Markets ETF, ticker symbol EEM, 1996, here, 2020 on the right side of your screen. You can make an argument, this is a fractal, and this is a similar fractal. Point A, similar to point A, a higher low point B, similar to this point B here, both occurred during a long-term period of consolidation. In both cases, we get a failed breakout look at point C and then a successful breakout look, a failed breakout look, and then a successful breakout look in calendar year 2020. This breakout was a sign of increasing risk appetite in calendar year 2004, just as this breakout in 2020 is a sign of increasing risk appetite. And we can make the case that this is a more significant bullish breakout. Why? This consolidation period lasted roughly 8 years. This one quite a bit longer at 12 years. And relative to this white space here, we have a lot more white space here telling us in here we have a much tighter base, making this breakout more significant in this window here. Thus, if this point here is similar to this point here, it might be helpful to know how emerging markets did from this point here to this point here. The answer? Exceedingly well. EEM gained from this point here to this point here an additional 194%. And that does not include the rally from this point to this point. Very, very similar to this concept. With debt, we said we need to examine a wider data set. Might be easy to look at this chart and say Shavaco Capital Management likes emerging markets. That is true. This is a bullish breakout. However, that doesn't necessarily mean emerging markets are the best place to be. How do emerging markets look relative to the S&P 500 on the same time frame? Not nearly as attractive in the present day. When we had the first breakout that we just covered for EEM in 2004, EEM was a clear leader relative to SPY. The breakout that we have today is not the case. Emerging markets are a clear laggard in the present day. Is it possible that this trend reverses? Absolutely, positively, yes. It's one of the reasons why we have a very small exposure, extremely small exposure to emerging markets in most accounts. However, that trend has not changed yet. This is a favorable look and still a relevant look. Very, very similar to the concepts covered in this December 17th, 2019 post. You can find the details by Googling the title on the previous slide, but the basic gist is this is what a bullish look looks like for these global indices. This is the transition to a bear market here in red. It's this area here. Then bad things happen. And then we get a transition back to a bull and we go back to green. So the million-dollar question in the present day is, what does this table look like today? More like this concerning period here or this constructive period here? The answer, constructive. These are all laggards. It's still relevant. EEM is currently a laggard, but this is still relevant from a weight of the evidence perspective. Just as it was relevant here, August 31st, 2008, all red. Eventually they switch back to all green. Once again, late. The S&P 500 bottomed in March of 2009. We don't get all green until the end of 2009. Many of these indices were laggards, but this is still helpful to us, just as this is still helpful to us. Once again, we're going to have to move extremely quickly. Feel free to pause your video player if needed. Top chart is IEF, intermediate term treasuries, relative to the S&P 500, IEF divided by SPY. Bottom chart is the S&P 500 in isolation. Indecisiveness between 2010 and the end of 2012. Long-term consolidation with a bearish breakdown here against bonds and in favor of stocks. If we look at the S&P 500, it has already broken out of the long-term consolidation box here. And this is somewhat of a confirmation of this breakout here in this case. If we walk forward, after the bearish breakdown here, bonds underperformed and stocks did extremely well walking forward. We know all good things must come to an end or the market needs to consolidate its gains, and that's exactly what happened here. This point here is similar to this point here. Consolidation in the bond versus stock ratio, a bearish breakdown in that ratio, a bullish breakout in the stock market. If we walk forward from this look here, bonds underperformed stocks significantly and good things happened in the stock market. This is another, the market needs to consolidate its gains look. And that's exactly what happens. We have a very, very similar setup in the present day. Bearish breakdown in the bond versus stock ratio, bullish breakout in the stock market. And since this look here can skew your perceptions, let's flip these charts and put the S&P 500 on top and the bond versus stock ratio on the bottom. Here are the exact same charts, January 16th, 2020. This bearish breakdown that's occurring now, this just happened, is very, very similar to this point here and very, very similar to this point here. Walking forward from those 2 points, bonds significantly underperformed. Walking forward from those points, stocks significantly outperformed for a long period of time. Simply telling us to keep an open mind about something similar happening relative to this bearish breakdown in the IEF-SPY ratio. And if we throw some arrows on the page, those concepts might be a little easier to visualize. This look here, something that just happened, aligns with everything that we've been talking about since January of 2019. Is there anything else? We've said numerous times that the data tells us that 2018 looks like a major low. Major lows don't happen very often. And look on this chart, doesn't happen very often. This is NYSE, new highs minus new lows weekly. We have only come down to this blue line here one other time, dating back to 1981. When did that occur? At the major low in 2009. First time that we made it back to the green line, in this case, September 18th, 2009. First time we made it back to the green line, in this case, December 20th, 2019. Therefore, it might be helpful to know what happened in the stock market walking forward from September 18th, 2009. The answer is really good things happen for a long period of time. How long is a long period of time? 8 years in this case. And that aligns with everything on the page here, and that aligns with the concepts covered in this MarketWatch article. You can find it by Googling this title here, and the concepts that we covered in last week's video dated January 10th, 2019. Back on November 18th, we said, however, in some admittedly extreme and rare cases, stocks can continue to rally from an overbought state. And that's exactly what we've seen since November 18th. Therefore, the 1995 analogy has been helpful. Let's take a closer look and see what we can learn from 1995. March 24th, 1995 is when weekly RSI had its first weekly close above 70. That's very, very similar to the first weekly close that we had above 70 on December 20th, 2019. In both cases, weekly full stochastic was overbought. Price action looks similar to price action looking in the rearview mirror from December 20th, 2019. Given this market was clearly overbought and clearly overextended on March 24th, 1995, very, very similar to the clearly overbought and clearly overextended look on December 20th, 2019, it might be helpful to know what happened walking forward 1 year from this overbought and extended state. The answer is really, really good things happened. Walking forward 1 year to March 24th, 1996, which was a Sunday, the S&P 500 tacked on an additional 32.39%. And for the most part, during the entire move, you could have said, I'm waiting for a pullback, the market is overbought. I'm waiting for a pullback because the market is overbought. And as we pointed out back on November 18th, admittedly, that is an extreme and rare case. But it still tells us that history says it is within the realm of possibility the S&P 500 could hit 4270 between now and December 20th, 2020. How could we get there? That would be a 32.39% gain from this overbought look here. Not a forecast, simply helps us keep an open mind about a wide range of outcomes. Something that was extremely helpful walking forward from November 18th. In this overbought look in March of 1995, similar to the overbought look in December of 2019, aligns nicely with this quote from Market Wizards here. You should expect the unexpected in this business. Expect the extreme. Don't think in terms of boundaries that limit what the market might do. That quote and those concepts were helpful on November 18th. This chart here and this gain here tells us it may be helpful walking forward from January of 2020. That falls into the to be determined category. What type of pullbacks did we experience on the daily chart from this overbought condition here walking forward 1 year? So let's switch to a daily chart inside of the blue box and see what we can learn. And we'll start on March 24th, 1995, when the market was clearly overbought and overextended. And that's this point here, and walk forward 1 year on the daily chart, allowing us to answer the question, how significant were the pullbacks after weekly RSI became overbought in March of 1995? The answer, not very significant. Between point A and point B, the S&P 500 from a peak to trough basis using closing prices never experienced even a 4.5% pullback, not a prediction about what may happen in the present day. It simply helps us keep an open mind about a wide range of outcomes, including some admittedly extreme and rare outcomes. S&P 500 performance walking forward from the dates of the recycled DeMark counts in 1995 align with these concepts here, and the gains from the overbought state from 1995 into March of 1996 also tell us to keep an open mind about better than expected outcomes. Anything else? Yes, hot off the presses, NYSE stocks greater than their 200-day exponential moving average, 1986, left side of your screen. Present day, January 2nd, 2020, on the right side of your screen. This is an extremely rare oversold condition in 1987, 2002, 2009, 2011, and a very, very similar and rare look at the end of 2018. We made it back to the green line from the blue line in 1989, 2003, 2009, 2011, and in early 2020. Thus, this type of round trip has only occurred 5 times in the last 34 years. Thus, it might be helpful to know, since this signal was just flashed 15 days ago, what happened in the S&P 500 walking forward from this date here, this date here, this date here, and this date here. The answer? Really good things happen for a long period of time. 100% of the cases, the S&P 500 was higher 3 months later, 6 months later, 9 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later, with the average gain in the S&P 500 walking forward from those dates just over 70%. This move from here to here, 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 and this move from here to here speaks to the past activity of some traders, including the activity of traders from December 2018 to January of 2020. In this table here, and these figures here, help us understand what the past activity of some traders may say about the future activity of other traders. When something similar has happened in the past relative to something that just went into the history books 15 days ago, this is what the future activity of other traders looked like. Thus, it's fair to ask, does all of this align with or contradict everything that we've been talking about dating back to January of last year? And the answer is simple. It aligns perfectly with all of it. And it aligns extremely well with the theory that this was a cyclical low within the context of a secular trend. Since the CCM market model uses a weight of the evidence approach. Anything else? Yes, similar situation here. Now we're looking at NASDAQ stocks greater than their 200-day exponential moving average. Extremely rare to get down here. Only happened in 2002, 2009, 2011, and 2016. And if you know your market history, those are all major lows. And getting back to the green line from the blue line only occurred in 2003, 2010, 2013, and 2016, and again in 2020. Only have data going back to 2002 in this case. Thus, this look here, only 5 times in the past 18 years. What does the past activity of some traders potentially tell us about the future activity of other traders? Here's the answer from a historical perspective. And you may feel the market's extended in the present day. Well, that was somewhat true in 2003, 2010, 2013, and 2016. And that is reflected in this table here, helping us keep an open mind about a wide range of outcomes and helping us have realistic expectations about 100% normal and to be expected volatility walking forward. But relative to our time horizon, this is the important portion of the table. 100% of the cases, S&P 500 was higher 9 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. The average gain in the S&P 500 of 65%. The median gain 5 years later was 72%. Since this is a NASDAQ breadth indicator, it might be helpful to know, how did the NASDAQ perform walking forward? The answer? Even better. The average gain in the NASDAQ walking forward 5 years from the historical points shown here on the upper portion of this chart. Average gain of roughly 93%, the median gain a tad over 99%, telling us to keep an open mind about much better than expected outcomes walking forward. And if we look at all 3 studies that we covered in this week's video, new studies, and put those 13 cases in one table, this portion of the table here is when we're looking backwards, and thus that's the past activity of some traders, and the table is what the past activity of some traders tells us potentially about the future activity of other traders. The composite look from all 3 studies, the new studies in this week's video, 100% of the cases higher, average gain 1 year out 13%. All cases higher 2 years later, average gain 24%. All cases 3 years out higher, 33% gain. 4 years, 52%. All cases 5 years, 66%. Every single case higher. And all of this tracks the past. It does not predict the future. It simply helps us assess the probability of good things happening walking forward relative to the probability of bad things happening. And all of it helps us keep realistic expectations about normal volatility over the next 1 to 6 months. And thus, everything that we've covered from a new study perspective this week, all 3 of the new studies, wholeheartedly align with the cyclical low theory within the context of a longer-term secular trend. And the studies this week align with the 4 studies that we covered in the December 20th video. 3 of them are shown on your screen. This is the table from the 4th study, and this is the summary table for all 4 of those studies. Once again, we have data in hand, things that just happened that tell us to keep an open mind about much better than expected outcomes walking forward. And none of that, the facts that we have in hand, things that we can see, measure, and put in a model, none of it aligns with the imminent recession nor imminent major top in the stock market and multiple year bear market theory. All of this is still relevant, including making no assumptions about what the data may look like tomorrow. And the only way that we can do that effectively is to walk forward with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.